the average stock correlation with the S&P 500 is pretty damn low.
That is some of the most important analysis nobody does. Correlations are what define a healthy bull market. When correlations are low, volatility is low, and correlations are low because investors aren't worried about the next foot to fall in a crisis.
Oh, they're more focused on the individual positives and negatives of companies than they are on macro
So this
crises.
is bullish. Investors are being discerning.
It's extremely bullish. It's why the VIX is below 15 or 15,
and
16.
has been for a while.
And has been for a while. The VIX, had 220 plus closes since March. Volatility is down because when everything zigs and zags differently, market volatility declines. And that only happens in bull markets, period.
Only in a bull market. You heard it here, right? So the question is, are we still in a bull market? Can this continue? A lot of bears out there, a lot of recessionists, a lot of 1970s inflationists. We're going back higher. Inflation's going higher, right? So let's check out the good, the bad news. Spoiler alert, there's a lot more good news actually coming on. And I think that's going to continue, right? So let's dive into it, starting with the fundamentals, fundamental analysis, right? What we're seeing is there are fewer and fewer companies reporting recession on the earnings calls. Okay, 4 quarters in a row, dropping back to pre-pandemic levels, right? We're seeing less and less calls. This is normalized, less and less earnings calls, less citations, and the stock market leads the economy. The stock market's looking 6 to 12 months ahead. These companies are going to signal what's actually happening, right, in business, and we're getting less of those. So that's positive sentiment, right? We also know that earnings estimates have been bottoming for the last couple months. They're starting to lift a little bit, not explode, but the bottom of earnings is pretty much in. We're going higher from here, unless we get a black swan. That's what it looks like. The estimates are going up, right? And if we go quarter over quarter, this is the first time we've actually had positive, right? Actually had positive earning estimates from analysts over the past 2 years when it comes to quarter over quarter. So they're raising their quarterly estimates, which we haven't seen for a long time. This is a positive. Earnings are starting to revise higher. Okay. Now looking at Q3, looking at earnings, year-over-year earnings. This is year-over-year earnings for the S&P 500. You can see there's some negative revisions here, or estimates, some positive estimates. But for the first time again, right, first time since Q3 of 2022, so about a year, obviously, we have positive EPS earnings. So going into this next earnings season, starting in October, we should be seeing positive earnings, right? And that's going to translate into a certain type of market. Maybe not everything goes higher, right? Investors are bullish. ETF liquidity inflows are increasing higher than 2021, 2022. Why? People even though the Magnificent Seven, like the top stocks, are moving higher, people want exposure. A lot of clients want exposure to the balance index, right? To the relative, not relative strength, to RSP, which is equal weight. They want a lot of that equal weight. So you see ETF flows increase versus fixed income, versus treasuries, dividend. Fixed income stuff is not taking the flows. It's going into US equities despite everything you hear. All right. Now let's switch over to inflation, right? If you have comments, throw them in there. Let's switch over to inflation. Right now, this is why I think I'm going to read this. This is why I'm extremely bullish over the next couple months going into November. There's really no reason for the Fed to hike in September, which is very constructive for the stock market, right? It's very constructive that they do not hike. We know rates are in restrictive territory, about 2% restrictive. We know core and super core, which we're about to look at, are falling. Yes, headline is up, but core and super core are falling. This is the New York Fed average CPI next 4 quarters. So the Fed is actually forecasting that inflation remains tame, that inflation doesn't keep accelerating. Maybe it's sticky for a while in certain areas, but it's tame. It's not going up, right? Next 4 quarters. Next, we have the Cleveland Fed inflation nowcast, right? And this is for core CPI. Core CPI is expected to fall, very positive and constructive for the stock market. And we're going to get that reading on Wednesday. Okay, and here's another reason why I think core keeps falling, right? And CPI in general, even though we do have elevated oil prices, elevated energy prices, vehicles, if you add vehicles and housing, it's like 57% of the index. But new vehicles, used car and truck vehicles, inflation is falling. The rate of change is falling. And you actually have, in used vehicles, you actually have deflation. Those prices are actually coming down. New vehicles are not going up as much as they were, but you're getting that deflation, right? And this is all about the Fed. The Fed determines their language, their posturing, I mean, the way they position their language and position rates are going to be very bullish for a certain market. Maybe not all markets, but for a certain market. There's always a bull market somewhere, right? Okay, let's move to housing. Oh my God, housing inflation is so high. We know the Fed is worried about housing. And what do we see here? Looking at the data, right? Just looking at the macro data, single family home and rent inflation are both falling. Okay, in red is the rents, and in black is the single family home value index from the Zillow index. Now, prices themselves are not falling because we're not in deflation for housing, but rents are. Rents are in deflation. You have a record of supply, multifamily record of multifamily supply coming online, being constructed. Expect rents to keep falling. Expect a secular shift into renting versus owning a home, right? Maybe not for you. Maybe it's not your personal situation, but expect that to happen. Okay, again, housing and cars are about 57% of CPI. Okay, so now it's like, okay, oil prices, that's it. That is is oil prices going to make housing go higher? No, it's not, right? It doesn't go into that. So the Fed's watching that. Okay, super core. Remember, the Fed is very focused on core inflation. They keep saying this, they keep reiterating core inflation. Well, super core inflation, X housing, services X housing on a month over month basis is pointing lower. It's at 0.2%. If you annualize that, you're looking at 2.4% inflation. You're pretty much at target. This is due to keep coming down because of the deceleration versus the previous levels. Now, the year over year is at 3.2%, right? But that's pretty tame. That is falling also, right? That is also falling. And we're going to get this data coming in. We're going to look at this. We're going to get this data coming in on Wednesday. Big day on Wednesday. We will be reporting on that data. I'll be live, and I'm just predicting that core is actually much better than people expect. So no wage inflation. This is also something to keep in mind because it's all about the Fed, right? It's all about the Fed, and the Fed is looking at inflation numbers as a whole. Core a little more than headline. There is no wage inflation. We're not seeing that. We went over this data all week. And then you have AI, automation, as a deflationary force coming into the markets, which again turns the market into a stock picker's market, which we're going to go over a little later, right? So all eyes on Wednesday, right? This is what we're looking at. Core, month over month. Inflation rate, headline, month over month. The core takes out energy and energy and food, right? So that's kind of what the Fed is more focused on. But the inflation rate should be going higher. This one's going to be nasty. It's going to go to 0.6, but that's a high consensus, meaning the expectation is so high, which I don't actually think that's going to be the case because oil kind of went sideways in August. Okay, so I don't think maybe I'm wrong, but 0.6 is a high expectation. If it misses, very bullish for the market, right? If it misses, very bullish for the market. Now, the year-over-year rate of inflation expected to go to 3.6. Maybe, like I said, if it misses or comes below that, very bullish for the market. Because the market can see gas prices, it's not a surprise. It can factor that in and price in lower. Now, core inflation, again, this is the weighted. When it comes to the Fed's decisions, core inflation is what we're going to be focused on going forward because we know headlines going up. Core inflation rate year over year is expected to come at 4.3, pretty big drop. That's consensus. Now, like I said, if vehicles are falling, if housing price inflation falls, if they start using rent data, which there's a rumor on the street they're going to start using real-time rents, that would significantly drop inflation lower. Okay, so we'll see how that factors in. Point being, Wednesday, all eyes on Wednesday. Put that on your calendar. All right. Now, it is not surprising. Okay, it is not surprising that the headline is due for a pop in oil prices. That's not a surprise, right? We're watching oil go higher. It's above the 83.50 warning zone. Now it's just a warning. It's like, okay, we know inflation's not going to collapse on the headline because oil prices are above the big level. The next question is, does it move sideways? Do we move sideways? And basically CPI headline is a little sticky. Does it drop off or does it break through the 94, 95 level and go to 100, right? If it goes to 100, that's going to be, bond yields probably go up, rates probably tighten. The Fed's going to be a little more hawkish. So we keep our eye on oil, but hey, we're above the level. We still have time going forward to factor this in, right? I know there's a lot of energy bulls out there. Some people say, who cares if oil goes higher? It doesn't move up core. It does not touch core. So maybe you do get headline up, but it's not going to go above 100 and just explode. There's no reason for that. But core collapses. And plus, that's going to put more restraint on consumers spending because they're going to say, okay, my energy prices are higher, and they slow down a bit, right? Now, moving on to policy, right? Global policies are starting to ease. This is basically all central banks, all central banks and their last move was a rate hike, right? The last move of all central banks as a hike is rolling over. So we're getting easing, global easing. Central banks are starting to not hike, right? Maybe they're pausing, but they are not hiking. That cycle is coming down. Now, rate cuts. These are all central banks whose last move was a rate cut. Well, that's going up. So you're getting rate cuts, you're getting pauses. The trend is changing, right? The trend is changing. The global policy is changing. Keep my eye on the money supply year over year for the 4 major central banks. That is moving up, right? That is a huge macro force. Liquidity coming into the market. You hear me talk about it all the time. Yes, M2 is suppressed in the US, but it is due to pick up. Plus, you got the PBOC, you got the Bank of China. They're printing. The European Central Bank, right? You have Japan still printing. So global liquidity is picking up, and most people want US equities, right? They want US equities more than anything. That's going to be a bid for the market. Okay, economic activity. Let's go to economic activity now. That is starting to bottom. You look at the ISM, services, and manufacturing cycles. These are the business cycle. This does represent the business cycle more than anything, and they're both starting to turn back up, right? So the business cycle is moving up, and what that signals is, okay, it's time to invest for investors, right? Now, keep in mind, in black, the services are expanding, right? The economy is expanding in the services sector. But if you move to the red, which is manufacturing, this is where it's very more volatile, and that's what I'm more interested in. Does it get above 50? We're not there yet. We're not above 50, but we're headed for 50, right? Or at least we're bottoming out. And typically when that bottoms out, EPS estimates go up. The recession, the manufacturing recession is starting to recover, and you don't have a recession, right? And it's all about defeating inflation, keeping those rates high and paused to make sure no inflationary pressures start to rise. Okay, jobless claims, the recessionists. Here's to the recessionists. Jobless claims are rolling over. Yes, they peaked up for a little bit, but you got too much policy coming in. You have people maybe filing for unemployment and then finding a job. There's enough jobs out there. We see the labor force is not out of balance. It's pretty balanced here. So you're not getting a spike in in jobless claims. You're not getting that spike. Okay, but here's the bad news, right? Rolling into that, probably a weaker second half Q3 consumer. We do know that personal savings are rolling over, right? And credit card usage or credit card debt in general is spiking. It has been spiking. Now, here's the thing. That also means more spending in the economy. So that doesn't necessarily slow down the economy. It just means, hey, is a consumer at a point where they completely collapse on their spending? Maybe they do, maybe they don't. I don't see it coming yet, but it is something to put in the back of your head if we see anything like that, right? Debt is rising. So this is total debt balances for the consumer. Student loans. We know student loans come back online. And the question is, are those going to be, people argue, oh, student loans, that's going to remove a lot of spending in the economy. Well, not everybody has student loans, right? And big spenders, they don't really care. They're going to keep spending. So maybe you do get a little bit of weakness, but most people don't even have to pay their student loans. They really don't have to pay them, number one. And number two, as long as they have a job, as long as they can service the debt, you don't really get a big collapse. But it is something to keep in mind if the levels do start to accelerate at a fast pace going into Q3. And like I said, if we have jobs, I don't really see that happening. People can service their debt. Debt always goes higher. We are in a debt-based economy. Now for the S&P, right? Weakness. More S&P companies are reporting negative than positive Q3 guidance. So we're actually getting more guidance negative, right? Information technology, healthcare. I mean, there was no positive guidance in healthcare. Industrials negative, consumer discretionary negative. This doesn't give you the full picture, though. I think what it really reflects is who's the equal weight, or the S&P as a whole is not expected to really grow EPS at a fast pace, but some companies are, right? And that's where we're going to get into. Oil could push yields higher. So here's another warning shot. Obviously, we already talked about this. If oil keeps going higher, well, depending on how it goes higher, how fast, right, the rate of change, if it moves sideways, the S&P is going to be okay, right? Companies in general, maybe the S&P stabilizes, but companies that can out-earn 5% interest rate, right? They're growing at 10, 15, 30, 40% a year. Tesla's growing at 50% a year in revenue. They don't care about elevated oil prices. That doesn't even factor in to Tesla's business model. If anything, it creates more demand, a more incentive to be in an electric vehicle, as we see California switching, as we see Europe and China. Okay, so oil prices are a risk though for yields to slow down. It's sort of like pressure, putting pressure down on the stock market in general. Okay, so oil pushes yields higher, which could push the dollar higher. All right, could push the dollar higher. We already see that yields sort of broke out. They're moving higher. They look very bullish. And we're going to get to that, why yields are going up and why that might stop here. But they're at the highs, okay? And the dollar typically goes higher because of two things. Either it's risk off because people are worried and they need a safe haven to go into a safe haven. It's a safe haven risk off move, or which I think is more the case, you're getting yield on your dollars, right? You're yielding those money market fund liquidity. Those money market funds are paying you to hold dollars. This is the most you've gotten paid to hold cash for a long time. So that could just be more of a bond trade. Okay, let's get out of bonds, yields go up, and let's get the risk free on our cash from the money market funds, right? So there's a couple of reasons why the dollar could go up, and there's reasons why that might slow. Here's the first reason, right? Let's wait a minute. Yeah, the dollar's going higher, yields are going higher. This is complicated. Let me try to speak this through. Let me try to smooth this out, okay? So we've had a record U.S. Treasury issuance of bonds, which means the more bonds you put on the market, right, the more supply of something, the less valuable it is, the less scarce it is. Therefore, the value of it drops. So there's been a huge increase in supply of U.S. Treasuries on the market because it's debt creation. It is the U.S. Treasury creating debt, making, printing money basically and throwing those on the market. And banks are forced to buy those. So you have a big supply coming online that pushes prices lower. That's what's making, and when prices go lower in the bond market, rates go higher. As the collateral falls, the interest to protect you, right? Collateral's falling. Well, I'm going to charge you more interest. The interest or the yield goes up, right? It's becomes more risky. So we've had this record short issuance and going up, but now we're seeing long-term issuance going into September, October is actually coming down. So the issuance from the U.S. Treasury, who's really putting pressure on rates higher because they have to create this debt, on the long end at least, they will not be issuing more on the long end. That's coming down. That means long rates should ease or at least stabilize. Well, short rates, maybe they stay higher, but we know the RRP, we know the reverse repo liquidity is sucking up those rates. The bull cases the bear cases, nobody eats those yields up, but I think they're going to eat those treasuries up. The bull cases, long rates stabilize because there's less issuance on the long side. On the short side, the reverse repo facility cash keeps sucking up the treasuries on the short end, right? Maybe it doesn't happen, but we're seeing that chart actually play out. And here it is. The reverse repo facility. This is a reason why I'm very bullish. Other than fiscal policy, other than fiscal printing liquidity in the fourth quarter Inflation Reduction Act, which again takes us to what? Takes us to a stock picker's market. Who's going to benefit from the Inflation Reduction Act, renewable energy, blah, blah, blah? Who's going to benefit from the CHIPS Act? We know. So that cash is coming in more so in the fourth quarter. Now, also, not only that, but you get the reverse repo facility cash that's leaving the Fed. I always say this, leaving the Fed, coming into the market. So what is it doing? Is it going to suck up treasuries or the S&P or both? And right now it's moving higher. Last time the RRP moved up like this, and it's really moving down. This is an inverted scale, but if it looks one for one with the S&P. So basically, as this cash leaves, it's coming in somewhere and it matches with the S&P. So last time this cash left the system, left the Fed, it's like a cushion. It's cash waiting at the Fed, then comes back into markets. That cash is exploding higher at the moment. And I think we catch a bit going into the inflation print, if it's not super surprisingly negative or on the headline or the core, then I think that liquidity finds its way back into equities. We see bond flows picking up. Now the playbook, right? Going into a high rate environment where rates are elevated, maybe they come down, but they start to, they stay elevated. Inflation is still not to target, but who's going to benefit from this most, right? Stocks, right? Stocks are companies with pricing power, meaning they can increase their prices. People will still play. Maybe Chipotle, right? Maybe Apple, who knows? But pricing power stocks are going to benefit from this to some degree. Not all of them. Okay. Now margins, companies who have strong margins, who can still earn, who don't get ripped away from the high rates, who are not getting hurt because they don't have a huge labor force, probably more software tech type. and that's why we see the NASDAQ has been outperforming. Okay. Revenue growth, right? Who's growing pure revenue growth? Who can grow their revenues at a fast pace? Probably more innovation plays, right? Where it's actually needed. AI is one of those big narratives. So who can grow their revenue? Balance sheets, right? You don't have so much debt versus your assets. You can manage in a recession. You can manage high rates. Who can do that? That's who's going to win going forward as a consumer slows down, who has a network effect, right? So your business model grows, Wall Street gets interested. Why does Wall Street get interested? Because they see long-term growth into the future, right? Who has those network effects? Well, you can ask me what I think. And efficiencies. This has been the playbook. Efficiency has been the word to push markets higher in this bull market. It's been efficiencies. Who can be efficient? Who can cut costs and still grow their revenues using automation, using AI, right? Who can actually do that? That's the question, because they're going to go higher. And I think this just continues. It is a world of efficiencies, because now you can't borrow free money. You can't just borrow at zero rates. You have to pay higher rates. So can you cut costs? Can you use automation to increase your revenue, to keep productivity up without losing? Okay, now one of these bullish correlations, also a very low, and this is I think this is a stock picker's market here. Yes, S&P can go higher. There's some headwinds there. There's some tailwinds and headwinds, but really individual stocks are going to boom. We saw Nvidia go to all-time highs. You see some of these companies that are exploding because what they can do in this environment, right? So you have a very low average stock. This is represents the correlation between average stocks and the S&P 500. When that correlation is high, right, it moves up. That means everything's moving together for some reason. That could be a good reason or a bad reason. One reason this thing shoots up, you get the Fed prints a bunch of money, right? They cut rates, everything goes higher, right? Everything goes higher. That's a bull market, but it's not necessarily healthy. It just means you're getting pure liquidity. This thing also shoots up, right? The high stock correlation, when you get a global, a global collapse in growth or inflation goes up, because everything reacts at the same time. So what are we seeing today? We're seeing that correlations between the average stock and the S&P 500 is at very much lows, right? Why? Because investors are more looking at the earnings reports. They're more looking at what these stocks are doing individually, stock pickers market, to actually grow their revenues, to retain their margins, to disrupt the legacy system. Right. So that's where we're at right now. We're in a stock pickers market. Now, I want to bring up really quick actually, we'll go to Q&A. If you guys have any questions, throw them in there, hit the comments. What up, Ronnie? What will bring down the price of crude oil? Glenn Stevenson, the thing that'll bring down the price of crude oil is going to be more supply. We have Iran. And if you check out the newsletter, I have this in there. You have Iran, you have a couple countries, about 5 nations plus the US, who are increasing their supply. Lower demand or higher supply. That's one thing. We already have lower demand. That's the reason they cut prices in the first place, because there's less demand. And so they're cutting prices. Now you get a bottleneck here, because if they keep cutting prices, they get to the point where other producers, rather other OPEC or non-OPEC producers, they start to gain market share, because what they're doing is they're increasing production. They're creating more supply while they're cutting supply. So they gain the market share. So if you're China, you're a big economy, you're going to buy oil from the lower producer, not the higher producer, right? So if you have Iran, or you have who is it? Iran. There's a couple other countries. There's like 5 of them. I have to look it up. If you're getting cheaper oil, if you have to pay $100 of oil to buy from OPEC, but then this other country, you're buying it at $67 a barrel, you're going to stick with them. Therefore, in the future, OPEC is sacrificing demand. They're sacrificing, to some degree, the market share that they have. So I think this is it's a game of chicken right now, because they're going to lose that supply. Plus the US is increasing supply. Yes, we have to fill the SPR. We have to create demand at some point, but we're also increasing demand. So a technology also very deflationary. So you got demand and you got supply dynamics going in for crude oil. That'll push it lower. What else do we have? Nvidia. Okay, Nvidia, please. What else do we got? If you guys put your comments on YouTube, I'll see them, because they get lost. I always say this. They'll get lost in the TikTok algorithm, or just re-ask your questions if you need to. On the TikTok, they get lost in the feed. All right. Now, while I'm waiting for your questions, if you guys do have questions, I want to break out the fact that, and I know you said Nvidia, I want to show the fact that here's, you guys know I'm very bullish on Tesla, right? Now, going forward, what are we having now? What do people have to argue with? This is an exponential trend. Most people don't understand this. 100% Glenn Stevenson, that this is a transition period. Exponential technologies are coming, right? NVIDIA blew up because of AI, because AI is an exponential technology, not because, oh, NVIDIA has a lot of chips. No, the only way to survive going forward is going to be AI. China, invasion of Taiwan, that's all about chips. What does that translate to? AI, better technology, right? So we're in an exponential era right now. And so Tesla is literally disrupting the whole automotive industry. We know that, right? You hear it all the time. Full self-driving is not just a linear thing. It's not like, oh, we might get it next month or the next week. It's exponential. It's around the corner, okay? Now they have also this $25,000 car coming out, a cheaper car coming out, and this is just a model of it. It's not the we don't know exactly what it's going to look like, but this is going out into 2025. So the revenue streams, or the TAM, the total addressable market for Tesla, continues to increase, right? It continue, you grow, you put on a new car, a new for a new set of people, a new demographic. There goes more market share for Tesla, more total addressable market. You can add that to the market cap. Okay. Now, another thing to keep in mind here, and we went over the top catalyst for Tesla, we'll go over them again, is this is California. This is looking at market share in California. Toyota in black, the black line is Toyota. They've owned the market, right? And they've owned this market. And I'm sorry, that's Tesla in black. Green is Toyota. I said that backwards. California Toyota has owned the market in California for the longest time, right? Toyota is the second biggest company in the world, Japanese made, right? And you can see that in California, has more GDP than most countries, by the way, right? I think it's bigger than Germany. It's huge, right? So also they start a lot of trends. So California, you can see the demand for Toyotas are falling, and Tesla is now surpassing them. It is the best-selling car in California. It is the Model Y was the best-selling car in the world, right? And these catalysts are hitting. And the reason I'm saying this is because Tesla is about to explode. I believe it does pass Apple. Oh, that's crazy. I think it's going to get back to $1 trillion and eventually pass Apple, because it is disrupting everything, because it has an exponential trend. Most people won't survive. Most car companies will not survive this next trend. That's the thing. Apple, are they really innovating? Not really. They're just a strong business model. They change the little things. They have subscription, they have services, but the energy storage business is larger than the EV business when it comes to Tesla. That's even bigger. And that is growing at a fast pace. You also have Cybertruck coming online. That's a new total addressable market. Yeah, let's go to the prices here. Put this down. And I remember last time Tesla exploded when the Model Y came out. So it's like a rubber band. A lot of people doubt it, and then all of a sudden everything comes at once, right? Everything comes at once. So let's go. So yeah, you have that coming online. You have full self-driving is going to be the big one, though. Full self-driving is going to be the key here. Let me take this RRP off, and then we will look at, you said NVIDIA. I'm going to look at NVIDIA. NVIDIA is definitely going to have that's why NVIDIA is going to have a lot of market share here going forward, just because they develop the most chips. Now, another thing to keep in mind, Tesla's not even using NVIDIA chips. Their chips are much more advanced when it comes to full self-driving than the NVIDIA chips. They have a supercomputer, Dojo. They have big data centers, just like these other companies. They have data centers. And the full self-driving FSD, full self-driving, and the car is the best AI on the market. When it does come when it does come online, that's going to be the most advanced AI right there. It can actually drive, and it's getting better every day. It's an exponential trend, which is very hard to compute here. You hear a lot of negatives, but that is the case when it comes to Tesla. So NVIDIA, take a look at NVIDIA. And so, yeah, this is a stock picker's market. There's a lot of fuel coming in to the markets in Q4. I stay bullish. I'm going to stay bullish here over the macro trends, because we're still in the uptrend. The market is not broken the uptrend. We're still in an uptrend. We're still moving higher. That hasn't been violated on a technical basis. The fundamentals are starting to improve. The macro, the core inflation's coming down. The Fed is pretty much pausing at this point. You need a black swan to turn this off. So looking at NVIDIA, right? It doesn't have a great technical setup here, but I mean, if you're it depends how you're looking at Nvidia. It really does. I say if you're looking over the long haul, you really want a lot of pain, and you want to scoop up some Nvidia on a lot of pain. You might have to wait till the next earnings report. I mean, who knows? I would stay away from it personally from an investment right now, until it really got hurt. Unless it came down like Apple, right? Apple pretty much got crushed. That's always a buying opportunity. See Apple with the wedge pattern there. That's always a nice buying opportunity when it comes to Apple. It's probably going to wedge, and this is what the market's actually looking like. It's looking a lot like Apple. Okay, it's looking a lot like Apple. So moving over to, I don't see too many comments, too many questions. So moving over to the S&P, right? Let's go over some of these market internals. For one, let's go to the futures. It's a little more clean chart. Okay, for one, you have a wedge here on the S&P. Look at these higher lows, right? From a technical perspective, the S&P keeps climbing higher, higher low, higher low, higher low, higher low, higher low. So it's the bears are wrong. They're just wrong. They can't be right until this trend breaks. Until we get a trend break, we're still in this bull market, right? Higher low, higher low, higher low. And you can put this in again. We can repeat this and say we got another higher low right here. Okay. So we're pretty much wedging into this trend, and it's going to come down to CPI on Wednesday. Like I said, core inflation is coming down. That's your catalyst. If it comes out higher than expected, we're probably going to come back and test 431. Or on the futures, it looks like it's 4,400 on futures, but it's 431 on SPY. SPX is like 4,300, something like that. So you're wedging here, and it's really inflation. It's inflation that comes out. I think it's going to be better than expected on the core side. It could be better than expected on the headline, but the real pain is probably going to come September, October, in the October print. Why? Because oil prices are actually moving up the fastest in September in this month, which doesn't factor in till next month. Okay. That's where it comes in. But if you get housing coming down, new vehicles are still falling, it might not make that big of a deal. So, and the Fed doesn't even decide next month. They're on pause. So the Fed doesn't talk not till November, where oil prices should roll over, right? Or at least the rest of the inflation, the rest of the magnets come down. And so the Fed stays on pause. So that's going to be big. I'm pretty sure they paused. The market is pricing in a pause here. And we're looking at this wedge pattern here for the market. It's wedging. It's holding the 100 daily moving average. It can't hold the 50. It's struggling against the 50, which I think it's going to need the CPI report really to get above that, right? Yeah, so you're holding that. And then when you look at the RSI, like there's no overbought territory here, right? We got to oversold. We're halfway through. We're pulling back, healthy uptrend, especially for the RSI, healthy uptrend. We're coming into the trend, pretty bullish from there. Now looking at the market internals, right? Moving a little further along. Look at the VIX. If we take a look at the VIX, I always say this, the VIX is below. When the VIX is below this 20 level, right? This 20 level, that's pretty much risk on. Oh, it's already up there. See, I've had it up there. Once you get below 20, very positive, very constructive. There's not a whole lot of interest against the S&P. That's what that represents. There's not a whole lot of interest against the S&P. And we're at 13. So like, this is extremely bullish. This is very bullish regardless. People think it just bounces. Buy VIX when it hits 13 and goes higher. No, the only time to buy VIX is above 20. Once you're above 20, and if you're spiking above 20, you come down, you buy at 20, because above 20 is very bad. Below 20 is more constructive. But VIX is below 20, so don't expect these bounces to really move much. It's not linear. It's very exponential, right? Emotions move really quick. So VIX, very suppressed, very bullish, right? You go to volatility of the NASDAQ of tech, that's even worse. The volatility is even lower because we know technology is solving issues. We know technology can still retain their margins, grow revenues, and biggest part of the index. And as soon as rates come down just a little bit, let's say the consumer does slow down, right? If they do slow down, PC comes down, core inflation comes down even further. Well, I mean, you're going to get rate sensitive assets like big tech move even more. Now, the most bullish chart that is really confusing is this bond volatility. Why? Because the less bond volatility, or the more volatility, the less liquidity in the market, because people pull back and say, okay, if when bond volatility goes up, collateral in the bond market is basically it's basically reflecting collaterals at risk in the bond market, right? Look at when do we have the banking crisis? In March, and the bond volatility spiked. Why? Because collateral was at risk, but it came down pretty quickly when the Fed stepped in. Why? Because they calmed down the markets. They came in and say, hey, your collateral is going to be fine. We're going to back all the deposits, XYZ. So bond volatility is still falling, which reflects the fact that liquidity can go higher, because for every US Treasury, for every piece of collateral you own at the bank or the banks own, they can lend out 5 to 10 as a derivative. They can, for every dollar you hold or US Treasury, US Treasury, you can lend out 10. So the lower the volatility, the more they can lend out. That increases liquidity, or the expectation for liquidity in general. And markets typically move off liquidity, regardless of what people might expect. And we know liquidity is going up. Equity credit risk. If you ever hear this credit risk, there is not. There's no credit risk. Credit risk is coming down. There's more interest in S&P. We saw the ETF flows. We saw the inflows to ETFs for stock market ETFs going up from 2021, right? It's even higher. So people are buying this bear market. They're buying into it. And there's not a whole lot of puts either coming into the market. This is a put to call ratio. And usually when it peaks, you go right back into a bullish trend. So it peaked. We made a higher low on the puts. It's going to take something pretty nasty to get us back above that. Could it happen? Yes, but I don't see it. I don't see it. If you bet on black swans, well, good luck. You might be 6 years waiting for one, if that's the case. So those are the market internals here. We're I think we're on inflation is gliding lower, and the market's very constructive. It's not a 1-for-1. It's not like, if oil or if inflation doesn't come down fast, then I should never be in equities. No, the more progress that's being met, this is junk bonds, the more progress that you see, the more people start to FOMO in. There's still a lot of cash on the sidelines, right? There's still a lot of negativity, which sets up for a bull market. When you're very negative, that sets up for a bull side capitulation, is what I meant to say, right? Moving over to crypto. Well, you're still waiting for regulation here. You're still waiting for that regulation. Now you have an Ethereum ETF, and you got a little bump on Ethereum. You got a little excitement on Ethereum. Actually, not really. I thought it did move up. I think it moved up and came right back down. But it's all about regulation when it comes to crypto. It may consolidate for another 12 months. It could consolidate, or it could just rip higher. Could consolidate or rip higher, but we are on the trend. We're getting ready for this next bull market, and for crypto in general. And the thesis is, well, once BlackRock gets passed, or whoever it is gets the ETF, you open up hedge funds, family offices, you open up big money, pensions, you open up 401ks, whatever it is, you open up big money to come in. They don't want to lock in private keys. It's not happening. They don't want to lose their keys. They're not tech savvy, but they do want exposure. Now you have the biggest asset managers automatically buying crypto, right, for their clients. The supply is already down. We know the supply is down. And then you go into the halvening, and you get, now you get the Fed cutting rates in 2024, which I think they can cut earlier than people think if inflation comes down fast enough. And you get the Fed cutting rates, you get a crazy cycle moving up. So I'm most bullish on crypto, on Tesla, Palantir, right? Palantir, some AI plays. There's some other stuff out there, but that's where I'm at. And that's what I'm looking at. I'm looking at KRE. Does KRE collapse? If it does, I'm expecting the Fed step back in, because this means a lot of bank deposits are going to collapse, and they are collapsing at the moment. I don't have the data, but a lot of bank deposits are the outflows. There's still a lot of outflows from these regional banks. Morgan Stanley, too big to fail banks. Morgan Stanley, Goldman Sachs, Wells Fargo, Bank of America, they're fine. It's these regionals who are in trouble if this continues, right? And that's really going to depend on, does the Fed pause? If they do pause, the expectations for treasuries going lower is going to slow down, because they're going to pause. That means that they're at least not putting downward pressure in the treasury market or the rates market. They're not going to force banks to lose more collateral. So I think this pause is going to be very bullish, and we're looking at the core inflation numbers. That's going to be key here. Looking at core inflation. If you are not subscribed, I got a newsletter. All the data is in the newsletter. I send that out. I believe on Monday we're going to go over all the catalysts for crypto going forward, which I think Tesla's catalysts are actually going to hit quicker than crypto's from a timing standpoint. unless all of a sudden the ETF just gets passed, then everything just starts colliding at once. So anyways, yeah, that's what I'm doing. Other than that, if there's not any other questions, I'll wait a second to see if there's any other questions, any comments or anything you might be confused on. We do these lives for you guys to ask more questions. If you want to challenge me, that's totally fine. I'll even send you an invite. But yeah, and cutting rates, also cutting rates, go ahead and throw your questions in if you need to. Cutting rates is not bearish. It is not bearish. That has not been, everybody shows 2001 and 2008. Here's the thing. The only time cutting rates is bearish is when the market is at all-time highs or near all-time highs, and the ISM, the business activity or economic activity from the manufacturing sector, is rolling over and going into contraction territory. That's when rate cuts have been bearish. Okay. If that's not the case, if economic activity is at the bottom where we're at right now, well, the Fed's not going to cut rates because if the Fed cuts rates, that actually makes economic activity go higher, because now you're lowering the cost to build, lowering the cost to fund growth, right? Also, markets at all-time highs, everybody's over-positioned. This is where people get confused about. If you're over-positioned, if people are over-positioned in the market, well, they get more scared. They're like, oh, they find a reason to sell, right? They're finding a reason to sell. When they're under-positioned, they're looking for a reason to buy. They're more so looking for a reason to buy. And that's why you hear all the negative news. Oh, the recession's going to hit. We're going to go down. Consumers are going to roll over because they want the negativity to price in so they can buy lower. Maybe it does. Maybe we do get a black swan. Maybe something does fall off. But what do you bet on? Where does the data lie? That's why we do the good news, the bad news, and there's much more good news coming in. S&P earnings are going higher. They're getting revised up. The Magnificent Seven are probably going to keep leading the market regardless. And, GDP is pretty healthy. It's starting to bottom out. Consumers are still spending. The U.S. is the strongest consumer on earth. Fiscal policy is due to hit. That's a big one. Fiscal policy. Now, let's say the consumer does collapse, right, in the fourth quarter. If they do, well, we're heading into an election cycle, right? What happens when consumers collapse? What do politicians do that want to retain their positions? They release stimulus checks. We might actually get stimulus checks. Oh, well, that's bearish. Thanks for the questions. I'm gonna hit you right now, Guru Claire. Appreciate it. Nice. Where are you from, anyways? Interesting name. So, real quick, let me finish. Make sure I don't lose my train of thought. So, they give stimulus checks. Now, let's say, oh, stimulus checks are very inflationary. No, because the labor force participation is very high. Supply chains are healthy, so it could take all the capacity for people to start spending again. Plus, if consumer collapses, you're in a recession, right? You're going into a recession, so that would speed up growth. That wouldn't necessarily. The reason why we had such inflation wasn't just because we got stimulus checks. It was it was also because demand went up while the supply chains were broken. We don't have broken supply chains. Supply chains are very healthy. Now you're getting onshoring. Now you're getting AI. Now you're getting automation. They're going to be even faster. More productivity means you can create more demand without inflation going up. Your GDP goes up. Very strong market, right? And you can still grow with interest rates at 5%. That's been the historical norm. It's only been the last 12 years, really, that we've had zero rates. Okay, so now these companies who can't handle that, they're going to collapse. GM, Ford, they cannot afford, and there's other companies, they can't afford high interest rates. They can barely pay their dividends. The more vehicles they make, Tesla is cutting prices. They're going to lose on margins, right? They have a bunch of backlog inventory that can't be sold. They're in trouble. That's who's in trouble. Innovation wins at this point. Whoever can innovate, whoever can create more productivity, better technologies, cheaper, faster, smarter, that's who's going to win here. That's why it's a stock picker's market. All right, I'm going to get to your comment there. Fed can't afford to turn on the money printer machines or pivot too early. Yeah, I agree. I don't think they're going to pivot. I would say they don't pivot too early. Well, let me get through the rest of your comments. Well, let me throw these on here so you guys can see. So, Claire, I'm going to call you Claire. I wonder where you're from, bro. That's an interesting name. I don't even know how to pronounce it. So he says Fed can't afford to turn on the money printer machines or pivot too early. Yeah, true. Very true. They're not going to turn on the money printer machines. They're not going to start, increasing the Fed's balance sheet. But here's the thing: they did in March. Gervin. I'm gonna try to pronounce your name. They did in March because KRE collapsed, because the deposits collapsed. They turned on the money printer and then they took it back off. So I think that's more so what we might see. If something does collapse, they take care of it really quickly. Remember, QE has only started since 2008. So we just started getting into money printer. Like the money printer wasn't on in the past. That's why everybody says recession, we're falling apart. They could just turn it on as quick as they want. They could turn the money printer on. This has never been the case in history. Not 2001, not 2008. 2008 is when it happened, but that's after the fact. Now we have these tools, fiscal policies, which is more debt. Oh, well, that leads to a negative economy going forward. Yes, that's why you must take advantage of the best economies. Because your wages will never outpace inflation or the Fed's balance sheet. You have to own the right assets. This is the asset crisis, right? We're in the crisis where people don't know where to invest. They're told, invest in real estate. Well, there's a lot of evidence that suggests real estate ain't going nowhere pretty soon. Maybe if you have some good deals, but unless you're in multifamily, but real estate is not beating the Fed's balance sheet. Most things are not beating the Fed's balance sheet. The only reason Warren Buffett is outperforming is because of Apple. Most of his other bets have been terrible. It's Apple that has led the charge. Berkshire Hathaway in general and Apple. That's it. Big tech. That is, that's it. Innovation. So that's the only thing that can beat this money printer machine. What else did you say there? They could be replaying the events from the 1970s when inflation spiraled out of control, but there was a big war for oil back in the 1970s. Totally different economy. Most of the economy was dependent on oil also. And that's where people get it wrong. You didn't have AI, you didn't have automation, you didn't have the tools we have now, you didn't have, the U.S. leading energy or production of energy. So the difference between the 1970s, there was a huge war. There's a big war, and maybe I can dive in that deeper one day. I'll do some research and try to explain that. And most of the S&P was energy, so they had good earnings, but it crushed. Once they fell, the market got crushed, right? So totally different market dynamics today than the 1970s. If you want me to, I can do some more research on that. But to me, it's pretty easy to understand here that we are not in the 1970s, right? This is not the 1970s, not even close. And I'm trying to think, what were the main reasons this is not the 1970s? I think it's demographics too. I think it's the way the economy is constructed, the supply. The amount of people who came in, this was the baby boomer generation, right? They all came in after the war and they spent like crazy. And that pumped, there wasn't enough supply, right? So, I'm going to have to look a little deeper than that. That's a good question though. That's a good comparison. I don't think it's even close from what I've seen. I just can't come to the knowledge right off the bat. And reach record high numbers, complete destroying of the U.S. economy. Yeah, we're not going to bounce that high. Now, here's how it does. Here's how inflation does destroy the 1970s again. Oil needs to jump over 100, get to like 120, 130, 140. That's how you get that 1970. So you have to bet that oil really, I know Big Man's Cummings betting on it, but you have to bet that oil ravages everything. But guess what? Most CPI is not oil. Actually, most of it is energy prices. But right now, natural gas is low. Commodities are not spiking, right? We're not in a war right now. Commodities are not spiking. We're in an AI war. We're in a tech war, which is why what's really inflating is chips, right? Well, companies, because of the value, not the actual chips, that's actually coming down because of the way it's produced. So we're not in a war for oil. Oil is not the main commodity in the US, right? Like it was. So I just don't see that happening. You need oil to really spike. Housing prices would have to go back up because there's no supply being built. And prices go up, people don't change, but that's not going to happen either because there's a lot of supply in multifamily, so people just shift. So those prices come down. Rent prices are actually going negative for the first time in a long time. So just not seeing it. Also, you're from Toronto, Canada. What up? Shout out to Toronto, Canada. Shout out. Thanks for joining the channel. Appreciate it. You're doing a great job explaining the complex topics so regular fools like myself can understand. Keep it up. I came across your channel recently on Instagram. Hey, cool. Thanks. Shout out to you guys, man. That's what makes me happy. I'm trying to simplify it because I've been in the market for a while and I was so confused. I'm like, how do I simplify this, right? One of the main things that people don't understand is the bond market. That's key. And I'll tell you this, from 2021 all the way till the peak was about 2023, I think in January, a bunch of cash left the system. Okay. This is like you could call it the black market of liquidity. It left the stock market. It left the bond market. And it went into the Fed's reverse repo facility. And what that is a facility where the Fed says, if you park your cash here, right, we're going to pay you an interest rate. What is that interest rate? The interest rate, and this is to simplify it, the interest rate they're getting paid to park their cash there is the Fed funds rate. So the higher the Fed funds rate goes, the more they get cash in their pockets, right? But here's the thing, they have to weigh out the risks. Well, do I want to be cash free at the money market funds, or do I want to own, this is after like a year holding your cash there. And then the US Treasury, the bonds of the US Treasuries, what they're doing is they're yielding about the same as the money market funds, but in 3 months. So you can collect the same amount of interest every 3 months. Well, that's taking that liquidity out of the reverse repo facility. And because people are like, well, I'm incentivized to be in US Treasuries, right? So all the treasuries being printed are actually getting eaten up by the investors. All the treasury liquidity that's supposed to push rates higher, which I don't think rates go higher because there's a lot of liquidity coming out, that's getting eaten up by this RRP liquidity, where the people were used to be at the Fed. Now, if the Fed starts to pause, what does that do? It tells you, okay, we're not getting more yield. We're not going to get any more yield. US Treasuries are more attractive. That brings down short rates if they jump in there, which I think is going to happen. And at the same time, they're going to say, well, now the stock market's recovering. We know we're going to get way more. We're going to get a lot more return. Are you kidding me? You're going to get 5% in a year. Nvidia's up 200%, 300%. What the hell? Apple's exploding. Tesla just is up from the year 100%. Nobody wants to stick in that money market unless there's a huge recession or inflation goes higher. That's why I'm bullish here, because inflation is not peaking higher. Oh, oil, you need oil really high. Core is coming down. The Fed's about to cut rates. Global economies are cutting. China turned on the money printer. Japan has the money printer on. Second and third largest economies. The US is about to pause. The government is still spending. Fiscal policy, Inflation Reduction Act, CHIPS Act, that is all going to these innovation type, technologies. Tesla, Zoom, right? Tesla, Zoom, whoever it is, there's a lot of bid for innovation. It's going to outpace, and crypto, we're getting blockchain pretty soon here. You think, I mean, I get excited about this because people don't see it coming, right? And I'm not trying to brag here, but when Tesla got smashed in 2018, I said, wow, this is a big opportunity. Europe is heading for EVs. China's switching to EVs. The governments have no choice. They're in debt too much to GDP. They have to stimulate and boost GDP where they're going to be able to get productivity back, where it can lower prices, right? So that's why China started incentivizing Elon to go into China. And Europe is doing it in Germany, right? The German factory. Mexico, they're having issues in Mexico. Now he's trying to go into India. Why? Because they know that it's going to lower the price of energy. Therefore, their GDP can go higher. They don't have to pay these high oil prices. That is the bull case for the next century. That is the bull case here. And governments have no choice but to pour money, fiscal money, some of it's your tax dollars, whatever it is, into those productive assets. Or right now, what's the blockchain case? Everybody's confused about blockchain. What is a blockchain case? It's this. And it's really confusing, but settlement fees extremely high, trade extremely high, uncertainty about how assets are managed, right? Extremely high. Stable coins, how fast it takes to settle. Stable coins solve a lot of issues because you get instant settlement, way lower fees. If you're moving trillions of dollars, you're paying millions of dollars in fees. Eliminate that, right? All of a sudden you're paying $10,000 on $1 trillion being moved versus 100 million. So that makes it cheaper. It makes it faster. Also, it's quicker because with central bank digital currencies, with crypto, Web3, Web2 meeting, you have this new layer where you can tokenize everything, right? Disney can tokenize their IP. You can tokenize everything, which basically means you can put it in your name on the blockchain. Nobody could take it from you. And the world doesn't have to depend on the US dollar now. Now they don't have to. This is why I think it's bullish for crypto, bullish for tokenization is actually BRICS. BRICS ain't going to take down the dollar. If anything, they're going to speed up the tokenization of money in general, right? The SWIFT network is the largest messaging system on earth, right? Between central banks, if you know what the SWIFT network is, and they're experimenting with Chainlink, cross-chain interoperability, which basically allows them to tokenize certain assets. And if you listen to Larry Fink, right? Larry Fink, biggest asset manager on the world, BlackRock, they're trying to tokenize everything because it makes the fees cheaper, because it makes it faster. You make more money, you make your system more efficient, and that's the only way to survive going forward. So you have to tokenize it. And that is the key there. That is the key. They all have blockchains already, but they can't access DeFi. They can't access the tools in decentralized finance, right? Web3, you can't access that because you have a private blockchain and a public blockchain. Well, CCIP connects the two blockchains. Now you can do that, right? Now you can cross-chain interoperate and you can create these greater efficiencies. It's very confusing. I get it. And, hopefully I can simplify it in the future. But point being, we're in a bull market. It's going to go higher. They have no choice. The Fed will turn on the money printer at some point. If the economy slows too much, they lower rate expectations, more liquidity. Okay. If they don't, if they just hold rates where they are, well, there's going to be more growth, right? S&P goes higher. Stocks still appreciate no matter what. Jervine Claire, I wonder how Tesla vehicles will operate in the bumpy roads and on complex traffic systems in India. That is a good question because, India, that's a very good question. I actually don't know how that's going to work because most of India's have crazy traffic jams. They don't even have roads really. They ride bikes. So I would even be, I wouldn't doubt that they come out with a motorcycle, right? Most people, but it has to be autonomous. The whole goal is autonomous. So maybe they have small taxis. I think that 25K vehicle, that smaller vehicle, is going to be prime for India. But more than this, think about this when Tesla meets up with India. It's not necessarily about vehicles. It's about the energy storage capabilities, which is much greater, right? India is buying cheap oil from Iran to accelerate their GDP, right? Because the less you pay, let's say you make $1,000 a month, you have to pay $500 in gas. Well, if you only have to pay $250, you have $250 left over. Therefore, you have more GDP. So if energy storage, if Tesla's energy grid system can save them energy, well, that's more revenue for Tesla and more expansion, and that's more revenue for India, and that's more global GDP. Therefore, you can pay off the debts. Therefore, you don't collapse. Therefore, you innovate. So it just all compounds on each other, right? So I think India is more interested in the maybe it's full self-driving, but more so because the way their roads are constructed, the energy storage business, which is growing at a fast pace. And trust me, the Saudis want a piece of it too. That's what Saudi Aramco happily is. It's not just, they know that oil is not going to be in demand going forward at the highest rate, at a higher rate. As technology innovates, and you can store, imagine the day you can store the sun's energy, it's over. It's over. The cost of energy goes to zero, basically, because you can use the sun's energy, which can power the whole grid in one day, right? Now, that might be far off, but that's the hope, right? You got to be, are you going to be optimistic or pessimistic? There's a lot of pessimists. I choose to be more optimistic about that. And accessible roads along the traffic jams, nothing compared to the U.S. Yeah, you're right. Nothing compared to the U.S. So India is going to be interesting. I don't know how it plays out. Yeah, I don't know how it plays out. Anyways, any other stuff? I just want to also put in there. Subscribe to the newsletter if you guys aren't already. It's free newsletter. So you can at least read everything I put out. Maybe you don't like to read, you just like to watch the videos. Well, on Monday through Friday, I'm live at about 2:45. I'm not always on time because I'm making sure I get the content right. Trying to get better. Go subscribe to the YouTube channel if you haven't already. And also, yeah, just trying to bring you the best content. You can always comment too on the newsletters. You can comment if you guys have questions, you want me to go over something else, or try to explain something that's very complex, whatever it is. I love when you guys go on the YouTube live because now I can interact with you. That's a lot better. So Monday through Friday, I'll be streaming. I think I'm going to switch to Mondays, doing more so the catalyst for the market because there's not a whole lot of macroeconomic data. So Mondays are kind of quiet when it comes to macro, and more so, well, unless it's coming from China, right? But for the US, it's a little more quiet. Is your newsletters weekly or monthly? They're weekly. They're weekly. I just sent one out right now. There's actually a there's a link in the bio. I'm sorry, a link in the description for YouTube. There's a link there. Takes you straight to the newsletter. You can sign up right there. Don't forget to check your emails to lock it in there. So yeah, they're weekly newsletters. Write one up every single week. What I see changing in the market. I'm just more bullish, right? I'm a little more biased because of what I see, and we've been bullish all year. And when I see something bearish, I'll tell you what we'll point that out. Maybe the Fed is trying to collapse the economy. Maybe they do slow down. But the thing is, the White House is not going to let that happen. So they're more likely to hold rates where they are. Yeah, last question, no problem. As we approach 2024, is policy lag effects the biggest concern in the market? I don't think so. Here's the thing about policy effect lags. I know people say, oh, the lag effects are going to be so powerful. Well, here's the thing. Think about this when it comes to housing. Real estate is a big part of the market. Most real estate is already locked in at 2 to 3% rates. Maybe I'm 3.5. I don't know exactly what it is, but they locked in rates early. Most people are not. Real estate is not making deals right now. They made them in the past. So when that rolls over, that's when the crisis effects or the rise of concerns start to come. Number two, S&P equity companies, they've locked in rates, right? They've already locked in low rates also. That's why you're not seeing equity credit risks rise, because most of that credit doesn't have to roll till 2030. Okay, so that's already locked in. You're not really getting, rates aren't going to hit the stock market. They're just not. What they are going to hit is banks, because banks are constantly buying US Treasuries. Banks have to use the Fed funds rate every single day, right? That is literally the 24. When you hear the Fed funds rate going up, that's the 24-hour rate for banks overnight lending and borrowing. It's not necessarily for you or for me. It just trickles into the market and it turns into market dynamics. But the Fed does not control the 10-year, the 20-year, the 15-year, the 30-year rate. That is all dependent on the investors in the bond market, which is why you have to keep your eye on the bond market to see what the bond market is actually telling you when it comes to long rates, right? The Fed doesn't control that. They influence it, but they don't control it. So also lag effects. Here's the other part about lag effects too. The higher the rate, whoever holds cash is actually yielding off that cash. So a lot of the baby boomers have a lot of cash, right? Or they're in fixed income instruments, and they're yielding and they're spending. So the lag effects will hurt certain industries, probably commercial real estate first, a lot of the banks first, but not systemically, right? It's not going to hit the too big to fail banks. It's not going to destroy real estate. Even if it does and their balance sheets really go out of risk, the Fed prints more money, right? It covers them up. That is the playbook. That's the playbook. They just print money, they cover it up, and then they keep tightening, right? They just take care of it. So they put the Band-Aid on, and then it heals and they rip it back off. That's pretty much it. So it's at the end of the day, it's money printing. That's why it's like it's really an easy bet. You get long these assets that are going to win over time, and you make sure they don't have too many risks to them. So I know people are expecting a big bear market. It's just not going to happen. Plus, you have like you said, the lag effects going into 2024. I think it does slow some areas. What it does is it separates the wheat from the chaff, right? Or it separates the people who've been making bad decisions, and that just doesn't mean everybody else is on even water. That means you take capital from one entity and that capital flows into another. That's why I'm so bullish, because even if you do remove capital and people fail and they default, that capital is going to find its way somewhere else. Who is that going to be? I think it's going to be Tesla. I think it's going to be Palantir. It's probably going to be Apple, Amazon, Google, Facebook, Tesla, Nvidia, AMD. It's probably going to be Bitcoin, Ethereum, maybe Chain. It's probably going to be the best technologies, right? Because that's who solves problems. That's where people feel safe. And that's where the government is also spending. So yeah, that's all I have for you guys. Hopefully you enjoyed the stream. Don't forget to like again, like I said, and I'll be on Monday through Friday streaming, see what the market has for us. It's all about inflation next week, right? CPI, that core number is going to be very important. And then a week from Wednesday, okay, I will be on. A week from Wednesday is when the Fed makes their decision, September 20th. Okay, I got it marked in my head. Mark it in your calendar. The 13th, maybe I'm off a little bit. I believe it's the 13th and the 20th are the two big days that the market's going to consolidate and rip higher off of. Okay, so keep your eye on that. You have a lot of catalysts coming in. All right, appreciate you guys. You guys stay blessed tonight. I'm gonna get ready, go to the gym, work out. Yeah, 100%. Make sure you guys get your workouts in. You guys go work out, stay fit, keep your mindset strong, stay disciplined, right? Stay disciplined, get your mindset strong. Eat healthy. Don't get there's a lot of poisonous stuff out there. So watch what you eat, read the ingredients, try to improve yourself every single day, right? Improve yourself so you can have some respect out there. And yeah, you guys stay blessed, and I'll catch you on Monday. All right. Have a good night. Be safe tonight. Don't do nothing stupid.